Welcome to the Explainer. So imagine walking into a room and just staring at a whiteboard that is completely covered in scribbles, arrows, overlapping lines, and conflicting notes. You literally can't make sense of any of it. Well, that's what most traders are staring at every single day. But what if you took an eraser and just completely wiped that slate clean? Today, we're going to do exactly that. We're doing a clarifying reset to master the 3-session chart and bring absolute clarity back to your trading strategy.
Let's be completely honest here. Are messy charts basically ruining your trades? Have you ever caught yourself marking every single level on the daily time frame, then the 4-hour, the 1-hour, all the way down to the 15-minute chart? By the time you're done, the whole thing is an unreadable mess, right? It causes total analysis paralysis. You don't need 100 levels to trade. You really don't. All those lines are just fueling your anxiety.
I mean, think about the difference. A cluttered chart that just breeds anxiety. It overcomplicates everything and drives decisions purely on FOMO, the fear of missing out. You see a tiny line break, you panic, you enter. Contrast that with a clean 3-session chart. This is where clarity lives. It forces disciplined, logical execution. Wiping your slate clean isn't just about making things look nice. It's a massive strategic advantage to weed out the noise.
All right, so the first step of our reset, marking the last sessions. We are stepping totally out of the chaos here, so treat this like a non-negotiable checklist for marking up your chart. Step 1, turn on your session indicators. Step 2, look strictly at the last 1 to 3 days or sessions. Step 3, find and mark your swing high and your swing low within that specific window. The swing high is just where sellers took control, and the swing low is where buyers stepped back in. That's it, nothing more. And I really want to emphasize that number, 3. 3 sessions is literally the absolute maximum amount of historical data you need. If you want to find the only swing highs and lows that actually matter right now, they're in that window. Anything older than that, honestly, it's just noise distracting you from what the market is trying to do today.
Okay, moving on to the next concept, the no trade zone.
So once you've got those recent highs and lows marked, you've essentially built your boundaries. And those boundaries create the no trade zone. By definition, this is the area strictly between that recent swing high and swing low where, and I mean this, absolutely zero trading occurs. Say it out loud, no trading. This is where price is just consolidating and hasn't chosen a direction yet.
Inside this zone, your one and only job is to do nothing. Seriously, reframe that in your mind right now. Doing nothing isn't a weakness. It's a highly strategic, totally profitable decision. You're basically guarding your capital from that nasty consolidation chop, refusing to play a game where the market is just ping-ponging back and forth. You just wait.
But look, that tension, it eventually breaks. Which brings us to identifying an indication.
So what happens when price finally escapes that no trade zone? Well, an indication is exactly that, when price breaks a swing high or swing low, giving us actual evidence of market direction. It's kind of like a violently shaken bottle of Coke. The pressure builds and builds during consolidation. The indication is that moment the cap finally blows off and the market reveals where it actually wants to go.
But, and this is a massive but, remember this phrase. This is information, not an entry signal. Say it like a mantra. Trading that initial breakout is a classic trap built purely to trigger your FOMO. It is extremely risky to trade the indication. Do not jump in just because the cap blew off the bottle.
Think about it, right? Right after the cap blows off the soda, what happens? The fizz goes everywhere. It's a complete mess. That initial breakout is just the blueprint. Early emotional traders jump into that explosion, putting their stop losses right below. The market uses those stop losses as liquidity to fuel the real move. You've got to sit on your hands and patiently watch the mess clear up before you even think about making a move.
All right, so the mess is finally clearing up. Now we've reached the final piece of the puzzle, waiting for session volume.
Let's look at how a typical trading day actually unfolds. The Asian session usually traps us in that no trade zone consolidation. Then London kicks in, maybe it just wicks out testing the waters without any real structure or continuation. Finally, we get to the New York session, which brings that heavy confirmed volume and a really clear indication.
Because the reality is, true execution requires New York session volume. We only strike when price holds outside that no trade zone, backed by real confirmed volume. If a break happens without volume or outside of a major session, it's probably just fake volume trying to trap you. You need the weight of the session behind your trade.
So let's tie this whole explainer together into a quick mental checklist. You can practically print this out.
Before entering any trade, ask yourself, 1. Is the chart clear? 2. Have I marked only the last 1 to 3 sessions? 3. Are we firmly out of the no-trade zone? 4. Has an indication occurred and cleared up? And 5. Do we have confirmed New York volume backing the move? If any of those is a no, you just wait.
The market is always going to show you its cards through those highs, lows, and indications. But the real question, the only thing standing between you and a successful trade, is this. Are you patient enough to sit through the no-trade zone, survive the FOMO trap, and wait for the true session volume? Take an eraser to those charts today, reset your mindset, and let patience become your absolute greatest trading edge.